Rezolve AI PLC is currently trading at $5.46 a share, putting it up a very noticeable 6.43% on the day. Now, seeing a move like that, your first instinct might be to hunt for a press release, a major contract announcement, or some groundbreaking news. But the truth behind today's surge is likely far less about a specific corporate event and much more about the chaotic, often misunderstood mechanics of a company that has just gone public through a SPAC merger. The story here isn't a simple headline. It's about price discovery in a low-float environment, and that's a very different and much more dangerous game for the average investor. The general expectation surrounding Rezolve AI is straightforward enough. It's presented as an intelligent mobile engagement platform. The idea is that it provides a software development kit, or SDK, that other companies can integrate into their existing mobile apps. This would allow a user, for instance, to scan a product in a store with their phone's camera and immediately get information or complete a purchase right there, or use audio watermarks from a TV ad to pull up a promotion. The narrative is one of seamless, AI-driven commerce, a B2B2C model designed to make everything shoppable. On paper, it sounds compelling, like a company building the connective tissue for the future of mobile transactions, a story that easily attracts traders on platforms like the Robinhood app or SoFi Invest looking for the next big thing in tech. However, the reality of the situation requires a much closer look, and it's a reality steeped in the complexities of its recent public listing. Rezolve AI didn't go through a traditional IPO. It became a publicly traded company by merging with a special-purpose acquisition company, Armada Acquisition Corp. I. This is a critical detail because de-SPACs, as they're called, have a very specific and often treacherous life cycle for their stock. The valuation presented during the merger process is based on projections, not always on proven historical performance. More importantly, when a SPAC deal closes, the original SPAC investors have the option to redeem their shares for cash. High redemption rates are common, and this removes a significant number of shares from the public float. The result is a stock with very few shares available for trading, which means even small buy or sell orders can cause dramatic price swings, like the 6% jump we're seeing today. This isn't necessarily a sign of strong conviction from the market. It's a symptom of illiquidity. This is precisely the kind of volatility that sophisticated traders on a platform like Interactive Brokers might try to play, while it can create significant traps for less experienced individuals looking for straightforward online investing opportunities. Looking at the stock's recent behavior, this volatility is the dominant theme. The daily chart is likely characterized by sharp moves on relatively thin volume. This is the market attempting to find a stable price for a company that is, for all intents and purposes, brand new to the public. We need to ask who is buying and who is selling. The sellers could be early private investors or PIPE investors whose lockup periods may be structured differently. The buyers are likely a mix of retail speculators attracted by the AI branding and the low share price, and possibly some smaller funds willing to take a high-risk position. Major institutional involvement, the kind you'd track through Fidelity Wealth Management or see in large-cap Fidelity ETFs, is almost certainly absent at this stage. Those larger pools of capital typically wait for a company to establish a trading history, report several quarters of financials as a public entity, and demonstrate a clear path to profitability. This is a name you would likely have to seek out in an individual brokerage account. It's not something that would appear in a managed portfolio like Schwab Intelligent Portfolio, which is designed to avoid this kind of speculative risk. The price action we see today is less a verdict on the company's technology and more a reflection of its current capital structure. To be clear about what Rezolve AI actually does, its business is about providing technology to other businesses. The goal is to get their SDK integrated into as many popular apps as possible, apps from retailers, banks, and telecom companies. Once integrated, Rezolve's platform can enable features like image recognition for shopping, geotagged marketing offers, and interaction with QR codes or NFC tags. They would presumably generate revenue through a combination of licensing fees and a percentage of the transactions facilitated by their platform. This model is entirely dependent on adoption. It's a classic network effect play. The more partners they sign, the more valuable their platform becomes to both consumers and other potential partners. The challenge, of course, is that the sales cycle for this kind of enterprise-level integration can be incredibly long and difficult. They are not just selling a product, they are asking large corporations to embed their technology deep within their own customer-facing applications, which is a significant commitment. Any serious investment analysis has to center on their ability to close these deals. Before its public listing, the financial details were confined to the documents filed for the business combination. Those filings are where you'll find the historical revenue figures, the cash burn rate, and the management's own projections. These documents need to be read with a critical eye, as SPAC projections are notorious for being overly optimistic. Looking ahead, the tension between the market's expectation and the underlying reality will define this stock's performance. The optimistic scenario, the one that drives the narrative, is that Rezolve AI successfully onboards several major clients in the coming year. If a top-tier bank or a major international retailer integrates their technology, it would serve as massive validation and could trigger a significant re-rating of the stock. Success here could make it a legitimate player in the mobile commerce space, potentially rivaling functionalities seen in much larger tech ecosystems. It's the hope of finding the next big growth story before it becomes a household name like Tesla stock or Nvidia stock that fuels the speculative interest. Comment below if you believe Rezolve's B2B2C model is a winner or if you think they'll struggle to get the widespread adoption they need. However, the more sobering reality is that the path forward is filled with substantial risks. The primary one is execution. The company is now operating under the intense scrutiny of public markets and must deliver on its promises. Failure to announce significant partnerships or show meaningful revenue growth in its upcoming quarterly reports could lead to a rapid loss of confidence. The second major risk is competition. While their platform sounds interesting, they are not operating in a vacuum. Tech giants like Apple and Google are constantly building similar visual and contextual search functionalities directly into their operating systems. A feature that is native to the phone's OS is a huge competitive threat to a third-party SDK that requires integration. Then there's the ever-present overhang of the SPAC structure itself. There are likely warrants outstanding that could dilute shareholder value if exercised. And, more importantly, there will be lockup periods expirations for insiders and early investors. When these shares become eligible for sale on the open market, it can create a massive supply imbalance, putting significant downward pressure on the stock price. This is a common pattern for de-SPACs and a risk that anyone considering self-investing in this name must understand. It is a world away from the relative stability of investing in established companies like Apple stock or through broad market Fidelity mutual funds. For those managing their finances through platforms like Fidelity or looking for investment help, this stock represents the far end of the risk spectrum. In conclusion, the 6.43% intraday gain in Rezolve AI PLC is not the simple bullish signal it might appear to be. The expectation is that this is an innovative AI company poised to change mobile commerce. The reality is that it's a newly public, high-risk de-SPAC navigating the treacherous waters of price discovery with a low-float stock. The current volatility is a function of its capital structure, not necessarily a reflection of its fundamental progress. The real measure of this company will not be found in these daily swings, but in its ability to execute on its business plan, sign key partnerships, and demonstrate a tangible path to sustainable revenue and eventual profitability. Today's price action is merely noise. The true signal will come from the company's performance over the next 4 to 6 quarters. Until then, it remains a highly speculative instrument, a far cry from a stable investment, and a testament to the fact that the most hyped stories in the market often carry the most hidden risks. Book disclaimer: this video is for educational and informational purposes only. It is not financial or investment advice. Always do your own research and consult a qualified financial advisor before making any investment decisions. Thumbs up! Don't forget to like, comment, share, and subscribe for more.